Let's start by taking a look at the Earned Income Credit. The Earned Income Credit, also called EIC, is a refundable tax credit. It provides a refund to a lot of low-income taxpayers who have earned income and meet certain other criteria, which is what we're going to look at. Especially at the VITA program, there are a lot of low-income taxpayers, which is what the program really is designed for. So this credit is a source of refunds for a majority of the taxpayers. It is very important to be careful that this credit is applied where it should be, and it is not applied where it shouldn't be, because the taxpayer could miss out on the credit when they deserve or get a refund when they don't deserve, which could also cause problems. Actually, could cause more problems for them than not getting the refund. So please make sure you go through this uh, twice if you have to, but really understand the earned income credit and the requirements, because it is very important. So to receive the earned income credit, all the taxpayers who are going to be filing the tax return must have earned income credit. It says in the name it's based on earned income. Now, earned income is income from wages, such as a W-2 income or 1099 income. It could also be tips, and it could be income from self-employment. So it doesn't necessarily have to be a job for someone. It could be a job for the taxpayer themselves. It just cannot be passive income. Passive income like rental, if they're receiving, a rent income from a tenant, or any lease payments for any other sort of thing. That is not passive. That passive income is not considered earned income. So again, earned income, for the most part, as far as we're concerned with the VITA program, it's going to be people with W-2s, 1099s, or just self-employed individuals. The taxpayer must have a valid Social Security number. Um, so this is not available to people who have an EIN number only, because this is a credit that's designed really for United States citizens and residents. The the taxpayer must be a U.S. citizen or resident alien all years. So this is a requirement for their status, but again, this is different from being present in the country, which we're going to look at later. This just says that they have to be a U.S. citizen or resident alien of the United States for all year. So if they just became a U.S. citizen this year in 2015 in the middle of the year, they would not qualify for this credit. The filing status cannot be married filing separate. So when we looked at the married filing separate, filing status, we said it was disadvantageous for a lot of reasons, and this is one of the reasons why. If the taxpayer files as married filing separate, they cannot claim this credit. Now, passive income, it really is investment income. It should be investment income here. Must be 3350 or less, $3,350 or less. Now this number may be different for the different years, so the number is not important. I just updated for the year that you're looking at. But the threshold, whatever the number is, the passive or the investment income cannot be more than that. So if someone has dividends, sales of stocks, things like that, and if that exceeds this number, they cannot get the earned income credit, because again, the earned income credit is for low income taxpayers, and it's possible for someone to have, not a lot of earned income, but they could have a lot of, investment income. So this is to prohibit, those people from getting the earned income credit. The last thing is their adjusted gross income must be less than the designated amounts. By that I mean these amounts. Again, these numbers are going to change, and they may be different for the year that you're looking at, but this is just to give you an idea. Just understand that there are these 4 different levels. The first one, depending on wherever you start from, if the taxpayer has 3 or more qualifying children, their earned income has to be below this number. For married filing jointly, it's a little bit higher. And then if it's 2 qualifying children, that's these 2 numbers, married filing joint, this number right here. And if it's only 1 qualifying child, then it's this number. And if they have no qualifying children, then it's this number right here, and then the married filing joint number. So again, these numbers could change, but just know that there are there's certain thresholds, um, and it's usually easier to qualify if the taxpayer has multiple children, because then the income threshold increases and it's easier to claim this credit. So in addition to meeting the requirements that we just looked at before, the taxpayer will either have a qualifying child and they'll claim the credit that way, or they may not have a qualifying child and they will claim the credit that way, but the requirements are different for these two individuals. So someone who has a qualifying child versus someone who does not have a qualifying child. The requirements that we looked at here, these apply to everyone, regardless of whether they have a qualifying child or not. So now let's start by looking at a taxpayer who does have a qualifying child. Well, the first thing is the child cannot be used by more than one person for the earned income credit or for any other benefits. We've looked at exemptions. We've looked at, claiming someone as a dependent getting their exemption, either as a qualifying child or a qualifying relative. Looked at qualifying someone for a head of household. So the thing is, the way it works with taxes is you can only get the benefit once. So if a child shows up on a tax return as a dependent, that child cannot show up on someone else's tax return to qualify them for the earned income credit or for the head of household or anything else. One child can only be on one tax return. It could be multiple things or one thing, but it just cannot be on multiple tax returns. So this is basically just emphasizing that if the child is on someone else's tax return as a dependent or for earned income credit or for head of household, that child cannot qualify the taxpayer for the earned income credit. Now the child must meet the following tests, and these should look familiar: relationship, age, abode, and joint return test. Now, if you remember the qualifying child requirements, these are the same. The only difference here is that the support test is not included, because for the earned income credit, the support test does not need to be met. So it's actually less stringent than the qualifying child requirement. So it's just these four right here. It's the same, the relationship test that we looked at, the same relationships. Age is again this, saying under 19 or under 24 if they're a student, unless they're permanently and totally disabled. Same thing for abode. If the child is temporarily away or the parent is temporarily away, those still apply. And the same thing for the joint return tests that we looked at. So taxpayers who do not have a qualifying child, the requirements for them are a little bit different. First of all, there's an age requirement. Someone who is below 25 cannot get the earned income credit. So the taxpayer has to be at least 25 years old, but less than 65 years old. So anyone over 65 or over also cannot get the earned income tax credit. The other requirement is that they cannot be claimed as a dependent by another person. This again kind of goes back to what we were talking about. If someone shows up as a dependent on someone's tax return, they will not be able to get an exemption again on another tax return or qualify someone or themselves for an earned income credit. So if someone can be claimed as a dependent by another taxpayer, they cannot get the earned income tax credit. I do want to make an important point here. It says cannot be claimed. It doesn't necessarily mean that they actually have to be. So let's say if John can claim his son Joe as a dependent on his tax return, but John decides not to, Joe still could have been claimed on John's tax return. So Joe would not qualify for the earned income tax credit even though he actually wasn't, but just because his father could claim him, that disqualifies him for qualifying for the earned income tax credit. I mean, how you would know about this is by talking to the taxpayer and generally through the intake form, which is a very important process, and it's important to ask the right questions to come up with these answers. and the taxpayer must have lived in the United States for more than half the year. So this is pretty simple. This is the one that I was trying to say before is different from what we looked at that had to do with must be a U.S. citizen or resident alien all year. This applies to everyone. Whereas the one we're talking about right now for taxpayers without a qualifying child is must have lived in the United States for more than half the year. This has to do with being present in the United States. Now here there are temporary absences uh, that we looked at under qualifying child do not apply here. So if the person is temporarily away for work or school and they're not in the United States for 9 months because they're out for work or for school, they will not be able to get the earned income tax credit.